We talked about the structure of interest rates in the one of the very first modules of this section. I'm going to revisit interest rates right now, or the structures of interest rate, and now that we've talked about corporate bonds, municipal bonds, and treasuries, and just give a concrete example of what that structure would look like. An interest rate for a particular security is composed of two parts, a base rate and a spread. And the base rate again is typically represented by U.S. Treasuries, and it includes inflation, and it is maturity dependent. So the base rate will be different from 1 month maturity bonds, 2 months, 1 year, 10 year, 30 year. So the base rate is dependent and is typically represented by U.S. securities. The spread here, so an interest rate is base rate plus spread. The spread is the risk premium, and that will depend on the riskiness of the bond. Here is what that structure of interest rates look from a graphical standpoint. On the horizontal axis is time, 3-month, 6-month, 12-month, 3-year, and 5-year in this example. And again, the base rate is typically represented by U.S. Treasuries, which are in blue here, and again, they're at the bottom. Then the horizontal axis gives risk, and as we go up that risk, we have higher interest rates. I have risk represented here by ratings or bond ratings, Moody bond ratings, AAA, AA, and again, as you move down that, you increase risk. Triple B, B, double B, and single B, and again, as you move down that, you increase the risk, and then finally junk bonds. So here's what the structure would look like: time on the horizontal axis and risk on the vertical axis. Now we're going to give a specific numerical example of that graph. And here we're going to start with the base rates. And this data that I'm going to use, actually the top part of this is Treasury issues. It comes from Wall Street Journal Online. And here we've taken data from that. I'm just taking the yield data from that. And you see there at the bottom in the blue, 2012, 2013, 2014, all the way up to 2041. This is in 2011, so the 2012 bonds is a year ahead, 2013, 2 years ahead, 2014, 3 years ahead, and so on and so forth. 2041 would be 30 years in the future, so that's 30 years in the future. And then you see our yields, or our interest rates, or what we would be looking at now. So our Treasury 1 year ahead is 0.107, 2 years 0.27, 3 years 0.46, so on and so forth. Risk is going to be represented by yields on municipal bonds, and here you see a list of these municipal bonds, and actually this is prepared for us and is also available on Wall Street Journal Online. They do this rather conveniently so we can look at the yield curve, but they go from 20, if you're looking at each line there, you'll see the line for 2012. That is the yields on bonds from 2012, giving it from AAA to AA on down to lower risk levels. But here's some municipal bonds. This data is prepared by looking at bonds of different maturity and then looking at different risk classes and then summarizing this in this table. So this table gives us a very easy way to look at its spreads and the structure of interest rates. In the next slide, we're going to take several lines of this data and combine it with the yield curve data on the previous slide, just to give the structure of interest rates that we saw in the beginning. The Treasury data from 2 slides ago and the municipal bond yields from a slide ago then are used to calculate this example of structure shown here. And again, this would be from October 2011, so these are showing the example of structure on 2011 using data on treasuries and municipal bonds as taken from the Wall Street Journal. Here, if you're looking on the slide, you can see at the bottom there, or at the bottom of the blue, we have 2012, 2013, 2014 again. 2012 is 1 year ahead, 2013 2 years, 2014 3 years. And then we have the treasuries. 0.11 up to 3.15. That's our base. That's what we're going to calculate the spreads from. And then the AAA, AA, A, and BAA are our risk levels. Now, if you notice, if you take any single maturity, and let's do 2012, our base rates, Treasury 0.11, our risk or interest rates increase as we lower the bond rating, and our yield increases as well. So we go from 0.11 at Treasury to 0.36 to 0.53 to 1.06 to our BAA, in that case having a 1.79. All right, we have the structure now. Now we can calculate spreads, and the spreads of AA at 3-year maturity, which would be the 2014, is 1.07 minus 0.46. So our spread there is 0.81. Another example of a spread is spread of A at 5 years maturity, which would be 2016. We have 1.63 minus 1.04. That gives us a 0.59 spread. So those are how we're calculating spreads. And again, rates generally increase as we have higher linked to maturity. So our treasuries our yields are getting bigger as we increase the the spread, and increase the link to maturity. And as we go up in higher risk, we increase the yield as well. We could have constructed the yield curve using corporate bonds, and here's an example of corporate bond data from Wall Street Journal. You can see what, again, this is from taken from the online version, but you can see there what happens to yields given different from different companies, and given different ratings from the various ratings company, and what those yields are currently at. We could have done the same thing with the structure of interest rates for corporate bonds that we did do for municipal bonds. One item to note about corporate bonds, and for that matter municipal bonds, one of the things that you have to remember is that some of these corporate bonds are of different structures. There's callability features to them, so that even given the same rating and same maturity or duration, you would have differences in yield be based on the callability of that bond. The structure of interest rates, the base rates, and the spreads will be impacted by the overall economy, and that should be obvious. But just to sort of divide the economic impacts into two portions, the base rate is going to change if we have a change in monetary policy. A change in monetary policy that loosens the money supply or makes money easier to get will generally lower interest rates. So we would see the base rates lower if we're trying to have an easy monetary policy. And overall economic outlook will also change those base rates. If we have an economy that's growing and robust, we might see those interest rates increase as there's more demand for loans, and a roaring, robust economy may also increase the chances of inflation, which would again change those base rates and could change the yield curve. The other thing that will change the structure of the interest rate will be risk changes, and an example of that would be because of the risk of recession. If that increases, the chance of default on riskier bonds increase, so you would expect to see the spreads of those bonds increase. If we, for example, had a increase in the risk of a economy going into recession, again that would, in the red here, increase the spread, and you would generally expect to see that more pronounced at higher maturity levels. Again, as you go out in time, the chance of bad things happen to you increase, and at higher risk levels, or those firms that are in the higher risk levels will likely feel economic downturn more than more solid companies. So far, what we've been doing is looking at yields, or these are actually projections of what the yields will be in the future. in class, we looked at returns, and here I show the example of those returns, and we're looking at returns after taxes on distributions for the long-term treasury, California municipal, long-term investment, and high-yield investment bond funds. And there's an important point to keep in mind here. Yields, or what we've been looking in the past, that example of the structures are projections. They're before the fact. Whether or not they actually do happen, you'll have to hold the bond and hold it to the end, and maybe you'll sell it or whatever. But that is a projection of what will happen. Returns are actually what happens. They're ex post. They're after the fact, and they again reflect what actually happened, and that will vary from before the fact um, projections. In this case, if you're looking at this chart, we had long-term maturity or long-term treasuries have the highest yields. We wouldn't usually expect that before the fact because higher risk should have higher returns. But for a variety of reasons, one of those is being that this long-term maturity had higher duration and was therefore impacted more by by um, interest rate changes in the overall economy, and also because we had a general increase in the risk and probably more defaults and delays in that high yield investment fund. Those two things caused the high yield treasury to have the higher returns after the fact. But again, yields that we showed in these slides are ex ante or before the fact. To summarize here, all right, when we're looking at the structure of interest rates, and we gave an example of it after talking about treasuries, municipal, and corporate bonds, the structure of interest rates is impacted by maturity. High maturity generally has higher yields, and I should have put generally in here because sometimes it won't. We have inverted yield curves occasionally, and risk. And the higher the risk, generally the higher yield. So when we're looking at that matrix, we expect to see higher yields the longer the maturity and the higher the risk, or in the upper right hand corner. Overall, risk, interest rate, and risk outlook will impact the entire structure of those curves. Um, Interest rate increases will raise everything up, and the risk outlook will increase spreads if we have an increase in risk.